Good afternoon. Patrick Dwyer and Greg Poole at Aligned Wealth in Miami, Florida. And today we're going to talk about long short extensions, which are a really hot topic in our world. And, one of the big questions we get from families all the time is we've had this incredible bull market is how do I manage my concentrated stock positions? Families are familiar with exchange funds, they're familiar with prepaid forwards, lots of different things. This is a new category that's been around for a couple of years. We have a lot of long short extensions opened up for our clients, including both personally. We're using them. And so Greg and I thought we would just kind of walk through like a short version of what the risks and rewards of these strategies are. They're not perfect.
Yeah.
And investors should be kind of aware of all of it.
Yeah.
Go ahead. Greg.
Yeah. So I guess what is a long short extension? Really at its core, it's a long short extension on as an overlay over a diversified equity portfolio, which we've been using for a long time with our direct index. So you're long a broad basket of stocks similar to our direct index portfolio, but the manager takes on some leverage. So they add to the long side. So you have more than 100% in the long side, and they short some stocks that they believe are weaker and reallocates that capital into stronger names.
Yeah. So you end up with a separate account, just like a direct index. You drop your concentrated position in that account. The manager sells a little bit of it, leverages it up, buys this. What you'll have 900 stocks long, 900 stocks short in the account and your position. And they start to harvest tax losses. As they net create tax losses, they sell more stock. And essentially how that works is your equity position, your concentrated equities position, depending on how much leverage you use in the strategy, you can do conservative or you can lever them up a lot and get it done faster, right? And get that done quicker. But that's the basics of a long short extension strategy. And this is a little schematic that you'll see up on the screen that kind of walks through it. It sounds more exotic than it actually is. I mean, it's really just kind of a levered direct index with shorts. Right.
Yeah.
I mean, that's really what it is. It's pretty basic product.
Yeah. Yeah. So there's really, we see families using them for two main reasons. The first is, as Pat just said, managing concentration risk. So if you have, a 20 or $50 million big position in one stock, this can really help you transition into a diversified portfolio over time. And again, as the more leverage you're willing to take, the time shortens up. But over time, you can get a diversified portfolio and not have to pay any taxes on day one. And the second is tax management. And so this is something we see a lot. We see founders who are going to have a really big tax bill coming down the pike. Putting this into use early allows them to generate tax losses that they can save up and then use to offset, either a big liquidity event or a big secondary sale.
Yeah. And so I think, like, for example, let's just say you knew you were going to take a bunch of money off the table towards the end of the year. We'd have 8 months to run a long short extension strategy to harvest as many tax losses as we could in front of that event. So you can use it, sort of proactively, or you can use it for an existing long-term capital gain in a portfolio. But I think what's very important to understand that a long short extension strategy, just like an exchange fund, does not get rid of your taxes. It just defers them. You're essentially taking the capital gain from the concentrated stock position and you're transferring it into a diversified portfolio. When you sell that diversified portfolio, you'll fully realize that gain, right? So this is something you would do if you think if your capital gain is large enough that the math makes sense to defer into a diversified portfolio that you don't have to sell, that you can theoretically own forever. But you'll have to keep running the strategy. You want to, if you want to defer the gain, you got to keep running the strategy. So that's the catch.
Yeah. We would normally say for a normal case, a direct index is great. But for specific cases where it's really worth taking that additional risk, that's when a long short extension can make sense. Because the other issue is there's tracking error. It's an active strategy. You're buying stocks long, you're shorting other stocks short, and you have leverage. It's possible, and these are good managers, that they can actually add some alpha by doing that. That's, of course, the objective. But it's also possible that it goes the other way and you have underperformance. So you're going to have underperformance and tracking error. Historically, they haven't, but it's entirely possible that they do. So again, it really needs to be worth it to take on additional risk.
Yeah. There's no panacea in wealth management, right? So I just want to say, like, this isn't like magic. It's not magic. And, I sort of look at it as, I would assume that they underperform the index over time. That's fine. If they underperform, if you just do the math on it, it's not hard. If the gain is 30, 35, 40% of your capital, a little bit of underperformance is fine. Having that capital fully invested for you is gonna matter more. And so we think for most people it would make sense to do this. Who don't have a need for that liquidity. Obviously, if you need the liquidity, different situation. But if you can afford to defer it, I think that makes sense to do these strategies.
Yeah, I mean, I'd say use it thoughtfully, size appropriate. Timing needs to be right and with clear expectations. I think this is about risk management. This is about tax timing and control. There is, like you said, no panacea, no magic, but these are, I think, a really a compelling solution selectively.
Yeah, and with a firm like New Edge at Fidelity or Schwab, where we execute these strategies, we use a number of different providers for it. The minimums can be as low as $3 or $4 million to do these things. At wirehouses, they can be a lot higher.
Yeah,
and they're not particularly expensive. They cost, depending on how much leverage you're using, you're paying for that leverage, but 35 basis points and up. So they're not, they're pretty tax efficient. So that is long short extensions. If you'd like to dig into that deeper, reach out to us and we'll be happy to go through that with you and have some conference calls and see if it makes sense for you, for your risk appetite. And also please like and subscribe to Aligned Wealth on YouTube, and give us a call if we can help you with anything. Thanks so much.
Thank you.